The purpose of this presentation is to provide an overview of the policy events that have transpired in the residential housing market for the quarter, to provide an overview of the key trends in the residential housing market, and to provide an overview of the home price level for a select group of cities throughout the U.S. Before we begin, I would like to let you know that this presentation was developed and narrated by Troy Adkins. I am the founder and owner of Adkins Capital Management. I have more than 15 years of residential real estate analysis experience, and I have over a decade of institutional investment consulting experience. In addition, I have served as a freelance financial writer for over 7 years, and I have written more than 20 published articles for companies such as Forbes, Investors Business Daily, and Yahoo Finance. My articles have also been published by more than 230 news organizations worldwide. Adkins Capital Management is a privately owned and independently operated firm. Our exclusive focus is on residential real estate. Adkins Capital Management is not affiliated with any parties associated with the residential housing industry. As a result, the information that we provide is objective and unbiased and is offered exclusively to help prospective homebuyers in making a prudent home purchase decision. I have developed a proprietary finance-based methodology that is marketed as ARAVA Analytics. I have incorporated ARAVA Analytics into an internet-based residential real estate analysis software application that is known in the industry as the Adkins Residential Home Valuation Analyzer. By utilizing the ARAVA Residential Real Estate Analysis software application, prospective homebuyers can conduct a comprehensive, accurate, automated, user-friendly, and affordable residential real estate analysis. ARAVA Analytics was utilized in order to generate the results of this analysis. In order to accurately assess the price level of homes in a city, ARAVA Analytics analyzes the relationship between the median home price level for the city and the median household income level for the city. ARAVA Analytics assesses the relationship between these two variables by taking into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan, and the assumption that no more than 28% of pre-tax household income should be spent by the people that live in a city in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, ARAVA Analytics precisely calculates the level of overpricing or underpricing of homes in a city. From the first analytical perspective, ARAVA Analytics determines the level of overpricing or underpricing of homes in a city by calculating the mortgage loan interest rate that justifies the price level of homes in the city. With this information, ARAVA Analytics compares the justified mortgage loan interest rate against the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan. By making this comparison, ARAVA Analytics can accurately calculate the level of overpricing or underpricing of homes in a city. In order to illustrate how the first analytical methodology is utilized, let us assume that ARAVA Analytics determines that the mortgage loan interest rate that justifies the home price level for a city is 6.5%. Let us also assume that the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan is 4.5%. Based on this information, ARAVA Analytics would classify homes in the city as underpriced because the prevailing cost of debt in the mortgage lending environment would have to increase by more than 2.5 percentage points before ARAVA Analytics would classify the price level of homes for the city as overpriced. Given this methodology, prospective homebuyers can use the spread between the justified mortgage loan interest rate and the national average mortgage loan interest rate in order to accurately assess the level of overpricing or underpricing of homes in a city. From the second analytical perspective, ARAVA Analytics determines the level of overpricing or underpricing of homes in a city by calculating the percentage of household income that would have to be spent by the people that live in the city in order to justify the price level of homes in the city. With this information, ARAVA Analytics compares the justified percentage of household income amount against the assumption that no more than 28% of household income should be spent in order to repay the principal and interest costs for a mortgage loan. By making this comparison, ARAVA Analytics can accurately calculate the level of overpricing or underpricing of homes in a city. In order to illustrate how the second analytical methodology is utilized, let us assume that ARAVA Analytics determines that the percentage of household income that would have to be spent by the people that live in a city in order to justify the price level of homes in the city is 48%. Based on this information, ARAVA Analytics will classify homes in the city as overpriced because the percentage of pre-tax household income amount that would have to be spent by the people that live in the city in order to justify the price level of homes in the city would have to decrease by more than 20 percentage points before ARAVA Analytics will classify the price level of homes in the city as underpriced. Given this methodology, prospective home buyers can use the spread between the justified percentage of household income amount and the assumption that 28% of pre-tax household income is the largest amount of money that should be spent in order to repay the principal and interest costs of a mortgage loan in order to accurately assess the level of overpricing or underpricing of homes in a city. It is important to note that ARAVA Analytics allows prospective homebuyers to tailor their analysis by utilizing the percentage of pre-tax household income that they believe is the largest amount of money that should be spent in order to repay the principal and interest costs of a mortgage loan, in conjunction with the actual cost of debt for a 30-year, fully amortized, fixed-rate mortgage loan that is available in their city. By tailoring their analysis to take into account these specific characteristics, prospective homebuyers will be able to make a prudent home purchase decision. Now that I have provided an overview of the ARAVA Analytics finance-based analytical methodology, let me turn your attention to the primary event that has transpired in the residential housing environment during the third quarter of this year. In August of 2014, Bank of America agreed to pay more than $16 billion as part of the largest single federal settlement in the history of corporate America. The settlement was in response to its sale of toxic mortgage securities and calls for the second largest U.S. bank to pay a $9.65 billion cash penalty and provide $7 billion of consumer relief to struggling homeowners and communities. Including the latest settlement, Bank of America will have paid over $65 billion to resolve mortgage issues with consumers, investors, and governmental agencies tied to its purchase of Countrywide in July of 2008 and Merrill Lynch 6 months later. In addition, during the month of July, Citigroup agreed to pay $7 billion to settle charges that it packaged bad mortgages during the run-up to the financial crisis. The deal includes $4 billion in penalties, $2.5 billion in mortgage modifications and other relief to homeowners, and $500 million going to 5 states and the Federal Deposit Insurance Corporation. In order to provide historical context to the settlements paid by Bank of America and Citigroup, it is important to note that in November of 2013, J.P. Morgan agreed to pay $13 billion in a settlement related to mortgage-backed securities that were sold ahead of the financial crisis. The $13 billion figure included $4 billion paid to the Federal Housing Finance Agency, which has overseen government-backed housing finance firms Fannie Mae and Freddie Mac since their 2008 bailout. J.P. Morgan also agreed to pay $4 billion to resolve securities fraud claims and another $1.1 billion to repurchase mortgages sold to Fannie Mae and Freddie Mac. In terms of the policy events that transpired during the third quarter of this year, Julian Castro, President Obama's nominee for U.S. Cabinet Secretary of Housing and Urban Development, was confirmed during the month of July. According to comments made by Secretary Castro to the Associated Press, potential changes in U.S. demographics may have a dramatic impact on housing. For example, Secretary Castro, citing a recent study by the National Association of Hispanic Real Estate Professionals, said Hispanics would represent nearly half of first-time homebuyers nationwide in 6 years. Hispanics are expected to account for 40% of the estimated 12 million net new households across the country within the next decade, and federal immigration law changes could add about 3 million homeowners and generate more than $500 billion in sales, income, and spending into the housing economy. In a statement made by Secretary Castro to the Associated Press, a booming Hispanic population will drive the future of America's residential real estate market. Secretary Castro also predicts that a major overhaul of federal immigration laws would create a further boon to home sales across the country. With that said, the state of the nation's housing will likely be unclear until a definitive position on immigration is reached by Congress and the President. Moving away from the housing events to the housing trends for the third quarter of this year, it is important to note that the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan began the quarter at 4.14% and ended the quarter at 4.11%. Most financial pundits expected the interest rate for a 30-year fixed-rate mortgage loan to remain steady or increase slightly during the quarter. Moreover, given the fact that the Federal Reserve has announced that it will begin phasing out its quantitative easing program in October, most people now believe that mortgage loan interest rates will trend higher in the future. For people that do not understand the monetary impact of the Fed's quantitative easing program, they should keep in mind that the central bank has been buying specified amounts of financial assets from commercial banks and other private institutions in order to raise the prices of those financial assets and to lower their yield. However, when the Fed starts phasing out its quantitative easing program, the financial market will have to attract capital from other sources. This in turn means that the yield on fixed income securities will need to increase in order to attract capital investments from the private sector in the U.S. as well as from abroad. As a result, prospective homebuyers will most likely have to pay a higher interest rate on the money they borrow in order to be able to obtain the capital they need to buy a home. With that said, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan has now been below 4.5% for more than 3 years. Going forward, prospective homebuyers should pay close attention to the trend in the mortgage loan interest rate environment, because interest expense is a primary financial burden associated with owning a home. To put this premise into perspective, prospective homebuyers should remember that a mortgage loan interest rate of approximately 5.3% will require them to pay to the lender twice the amount of their mortgage loan if they make their scheduled repayments and carry their loan to maturity. In order to accurately assess the financial impact of the debt service obligation that is associated with a mortgage loan, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer. In terms of conducting residential real estate analysis by undertaking a historical assessment of U.S. housing trends, an interesting finding can be made by using the Adkins Residential Real Estate Analysis software application. For example, according to the U.S. Census Bureau, median household income was $52,250 in 2013 and $30,056 in 1989. In comparison, the median new home price level was $265,092 in 2013 and $120,383 in 1989. As you can see from the chart, it appears that a significant problem in the residential housing market has developed over the past 25 years, as new home prices have increased at a much higher rate than household income. Indeed, this issue could be a significant problem because most prospective home buyers obtain a mortgage loan in order to purchase a home, and they repay their mortgage loan with their household income. Therefore, household income and home prices typically need to move in lockstep in order to maintain a stable housing environment. With that said, the dramatic decrease in the national average mortgage loan interest rate for a 30-year fixed-rate mortgage loan in 2013, which was 3.98%, versus the national average mortgage loan interest rate in 1989, which was 10.32%, brings to light some key points that prospective homebuyers need to consider. For example, when people look at the relationship between median household income and median home price levels for 2013 versus 1989, there would likely be more concern about the residential housing environment in 2013 due to the pronounced mismatch between the median household income level and the median home price level during that time. However, due to the much lower cost of debt in 2013, only 29% of household income would have to be spent by homeowners in order to justify the median new home price level in that year. Moreover, the national average mortgage loan interest rate for a 30-year fixed-rate mortgage loan would only have to trend down from 3.98% to 3.7% in order to justify the home price level. Therefore, while on the surface it appears that a mismatch between the median household income level and the median new home price level was a material problem, based on the justified percentage of household income amount and the justified mortgage loan interest rate amount, the median new home price level was only slightly overpriced for the nation in 2013. In comparison, in 1989, the median household income level and the median home price level appear to be more properly aligned. This in turn would likely lead people to believe that the residential housing environment was stable in that year. However, given the high cost of debt for a 30-year fixed-rate mortgage loan in 1989, 44% of household income would have to be spent by homeowners in order to justify the median new home price level. Moreover, the national average mortgage loan interest rate would have to decrease substantially from 10.32% to 5.75% in order to justify the median new home price level. Therefore, while it appears that the relative alignment between the median household income level and the median new home price level in 1989 was satisfactory in terms of maintaining a stable housing environment, based on the justified percentage of household income amount and the justified mortgage loan interest rate amount, the median new home price level was significantly overpriced for the nation in 1989. Now that I have provided an overview of the residential housing events that have transpired over the third quarter of this year, let me provide an overview of the home price level for a select group of cities across the U.S. For the third quarter of this year, 20 cities that make up the Adkins 60 City Home Price Index were classified as overpriced for the quarter. The top 5 overpriced cities were Honolulu, San Francisco, New York City, Los Angeles, and Newark. In terms of a relative price level analysis, it is important to note that given the home price level for the top 5 overpriced cities, it is not possible to justify their home price level by reducing the national average mortgage loan interest rate from 4.11% to 0%. Therefore, in order to classify the homes in the top 5 overpriced cities as underpriced, it would have to be deemed prudent by prospective homebuyers to spend more than the respective justified percentage of household income amounts, or the respective median household income level would need to increase to the appropriate level that is within the range of $50,363 and $149,060. As a last observation, based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities would need to fall to the appropriate level within the range of $153,227 and $337,513. In order for prospective homebuyers to accurately assess the level of overpricing or underpricing of homes in their community, they can do so by using the Adkins Residential Home Valuation Analyzer. On the other side of the spectrum, 40 cities that make up the Adkins 60 City Home Price Index were classified as underpriced for the third quarter of this year. Detroit, Buffalo, Pittsburgh, Des Moines, and Wichita were identified as the most underpriced cities in the index. In terms of a relative price level analysis, the national average mortgage loan interest rate would have to increase from 4.11% to more than the respective range of 9.75% and 13.8% before homes would be classified as overpriced. Again, for prospective home buyers that would like to accurately assess the level of overpricing or underpricing of homes in their community, they can do so by using the Adkins Residential Home Valuation Analyzer. Given the events that have transpired in the residential housing market this century, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home well into their retirement years, prospective homebuyers should subscribe to use the ARAVA Residential Real Estate Analysis software application in order to properly assess the level of underpricing or overpricing of homes in their community, the largest amount of money that they should spend in order to purchase a home, and the amount of money that they would need to earn on an annual basis in order to be able to afford to purchase a specific home. In addition, prospective home buyers should subscribe to use the ARAVA Residential Real Estate Analysis software application in order to accurately assess total home ownership costs, expressed as a percentage of household income, and to determine how much a home would need to appreciate in value each year in order to offset the costs associated with owning a home. For more information about the Adkins 60 City Home Price Index, the Adkins Residential Home Valuation Analyzer, and ARAVA Analytics, please visit the Adkins Capital Management website at residentialrealestateanalysis.com. Thank you for taking the time to listen to this presentation.